Financing the business. Cash. It's the lifeblood of any business. And let's face it, we all need a little extra cash to get things off the ground or fuel our growth. So in this session, we're going to dive into the nitty-gritty of financing and explore some key factors to keep in mind when you're on the hunt for funding. In this session, you'll learn how to locate, evaluate, negotiate for, and manage sources of money to help you start and expand your business. Here's what we'll cover today. Getting started. How much money do I need? Where to get the money? What kind of money to get? Evaluating lenders. How to get the money, after you get the money, quick tips, top 10 do's and don'ts. Get ready to level up your financial game. Getting started. If you've been thinking about starting your own business, it's time to dive into the exciting world of funding. Maybe you've got a stash of personal savings that can launch your idea, or perhaps you need a boost, be it a little extra cash or a bigger investment to bring your business dreams to life. Building a customer base and bringing in profits takes time. That's why it's crucial to have enough funding in the beginning to keep your business running smoothly. Traditional banks might want a proven track record of profitability. But don't worry, because we've got some strategies up our sleeves to increase your chances of getting funded. We'll even introduce you to alternative funding options. Oh, and we'll sprinkle in some handy tips on how to find the necessary funds to keep your business going. Remember, when you borrow from someone, even if it's just your future self, they expect to be paid back. So make sure you're making enough cash to cover those loan payments and keep a close eye on your expenses and cash flow. After all, you don't want to jeopardize your financial future with a debt that's difficult to repay. This session is just the beginning. It'll set you up nicely for accounting and cash flow session where we'll dive even deeper into the exciting world of financial management. Get ready to conquer the business world because your funding adventure starts now. How much money do you need? Before you begin looking for a business loan, you should have a written plan for how much money you need and how you will use the money and how long you will take to repay the loan. Trust me, having these details down on paper will save you a ton of headache later on. Now, let's talk credit scores. It's a good idea to know your credit score because it can affect your interest rates. And hey, if you've got some collateral that you're willing to put on the line as a loan guarantee, that's worth considering too. We'll delve deeper into credit reports and collateral a little later in this session, so stay tuned. Things don't always go as planned in the business world, so it's wise to have some contingency funds tucked away just in case. You never know when you'll need a little extra cushion. Starting a business doesn't always require a big initial investment. Many successful ventures have kicked it off with a relatively small amount of cash. If you don't yet know what kind of business you want to start, you might want to check out our partial list of businesses you can start with very little cash. A well-thought-out business plan is your best friend. It helps you understand your customer acquisition costs, how to cater to your existing customer base, and most importantly, how much profit you're likely to make once your business is up and running. Armed with this knowledge, you can estimate how much financing you'll need until your business becomes profitable. Oh, and don't forget to factor in startup costs like business licenses, websites, and inventory purchasing. They can add up. If you're feeling a bit overwhelmed with creating a strong business plan or predicting your future cash needs, don't worry. We've got sessions dedicated to those topics too. Head over to Moby's website for more information. When it comes to funding, it's crucial to have enough money to cover your expenses for several months, unless you've already got a lineup of eager customers ready to buy your product or service and help you make a profit. Make sure your funding amount is sufficient to weather the storm until your business starts turning a profit. Your expenses include things like startup costs, buying equipment and fixtures, getting a computer, building a website, licenses and permits, inventory, operating expenses, product or service production, delivery, taxes, rent and utilities, payroll, owner pay, contingencies and emergencies. When it comes to startup costs, it's best to keep them as low as possible and delay them until you have some solid proof of concept. I'm talking about real people who are not just expressing interest but are committed to buying your product or service. So hold off on splurging on those nice-to-have items for your business. Instead, be smart and focus on the must-haves, the things that are absolutely necessary. Don't forget that there is also the invisible cost of cash flow, the gap between the money you spend to produce what you sell and depositing the money from the eventual sale. Think of it this way. You may have made the sale and technically earned the income, but until you receive and deposit the cash, you might not have the funds you need to cover your expenses. And that's where borrowing cash to bridge the gap might come into play. Let's break it down with an example. If your business involves making a product, you'll need to purchase raw materials and process them into finished goods before you can make a sale. That means you'll be shelling out money for those goods, as well as shipping and processing costs well before you even earn any income. Even in a service business, if you provide the service and then invoice the customer, it might be weeks between doing the work and getting paid for the work. And guess what? While all of this is going on, your overhead expenses, things like rent, telephone bills, marketing, still need to be paid like clockwork. Be prepared for those gaps between spending money, earning money, and actually depositing money into your bank account. Where to get the money? When it comes to finding money for your business, there are tons of options. The key is to find the right source or sources that match your specific needs and situation. Different lenders have different areas of expertise. I mean, you wouldn't go to the same place for a car loan and a real estate loan, right? Find that lender who's most likely to give you a big, resounding yes. Examples of lending options for a small business include personal savings, credit cards, friends and family, banks and credit unions, alternative lenders, microfinance, crowdfunding, peer-to-peer lending, equity financing, venture capital, angel investment, specialized lenders, community development financial institutions, or CDFIs, economic development organizations. Borrow from yourself. The best person to borrow money from is yourself. Trust me, it saves you from any potential awkwardness with family and friends or the hassle of going through the whole bank loan process only to end up having to put your personal funds as collateral anyway. When it comes to funding your business, your personal savings should be your go-to. Start stashing away some cash in a high interest rate personal savings account specifically for this purpose. It's a good idea to open a separate savings account just for your business savings. Not only will it keep things organized, but it will also give you a clear picture of how much you can afford to invest in your business each month without compromising your current financial obligations. Now let's talk about credit cards. If your funding needs are relatively small and you can start earning income quickly, using credit cards for short-term cash flow assistance might be an option. But be careful. Those credit cards come with steep interest rates. It's crucial to pay off the balance in full each month to avoid increasing your overall debt and getting stuck with those high interest charges. Even if you manage to qualify for a loan, most lenders want to know you're serious about making your business a success. They might even ask for a personal guarantee for the loan amount. I need to mention that while it's technically possible to dip into your retirement account or take out a home equity line of credit to borrow from yourself, it's generally not recommended. Leave those options as last resort. Last but not least, in the midst of all the excitement of launching your new business, it's easy to lose track of your startup costs and how much you've invested in materials, equipment, inventory, and all the other items. Make it a priority to keep your personal cash separate from your business cash. That way, you'll have a clear understanding of the exact amount you've invested in your business. Borrow from friends and family. If your funding needs are relatively small, friends and family can be a great source of startup capital and cash. They can be more willing to give you a small amount rather than loaning you a larger amount. That way they don't have to stress about whether you'll be able to pay them back or if they can afford it. If you do borrow from someone you know, treat that loan the same as you would a loan from the bank. Don't let the informal nature of the arrangement make you lax about it. Take a moment to write up an agreement that outlines all the details. How much are you borrowing? What interest rate will you be paying? When and how will you make those payments? And most importantly, when will the final payment be due? Having a simple written agreement can go a long way in preventing any misunderstandings down the line. If your loved ones are kind enough to lend you a hand, make sure to handle it with care and set clear expectations. Borrow from a bank or a credit union. Most people think of going to the bank when they need to borrow money, but don't always think about what makes someone loan worthy. A bank's primary concern is your ability to repay your loans fully. Your ability to make payments consistently comes from your cash flow. So, to get a loan at a favorable interest rate, you must be able to create cash flow projections that show your ability to make your loan payments. Having a good credit score will also increase your chances of getting a loan and may also help you get a lower interest rate and other favorable terms. A credit score, or a FICO score, is a prediction of how likely you are to be able to pay a loan back on time, based on information from your creditors, like credit cards. You may also be able to see your FICO score in your monthly credit card statement, your bank statement, or through myfico.com, which has a free plan. The site also has a paid plan allowing you to see your score variations as computed with information from all three major credit bureaus. It is also important to examine the detail of your credit reports as collected by the three major credit bureaus to look for errors or evidence of potential fraudulent activity. You can access your credit report annually for free through the Federal Trade Commission at annualcreditreport.com. Get an SBA-backed loan. If you live in the U.S., the U.S. Small Business Administration, or SBA, works with certain lending partner banks to offer small business loans. While the SBA does not typically make direct loans, they will guarantee a portion of the loan for some of their products usually offered by banks. These types of loans are designed to decrease the risk to the lender and can allow business owners who might not otherwise be qualified to receive debt financing. SBA microloans come with additional counseling and education to help you run a successful business. Microloans are usually offered by CDFIs. If you're curious and want to dive deeper into the world of SBA funding programs, visit the SBA Funding Program's website. You'll find a wealth of information about funding options along with their main website that covers many small business topics. Borrow from alternative sources. When it comes to funding your dreams, you don't have to limit yourself to the traditional bank or credit union route. Alternative lending is any type of financing that falls outside of traditional lending, such as bank loans. These options can give you the flexibility and freedom you need to fuel your business without relying solely on friends, family, or emptying your own piggy bank. When you're considering any funding source, it's essential to do your homework. Take the time to evaluate each lender and carefully weigh the factors that matter most to you. Look at the size of the loan that they offer, the cost associated with obtaining the loan, the interest rate they'll apply to your loan, the payback structure, the repayment timeline, and those all-important monthly payment amounts. Comparing loans can be a bit of a puzzle. Some lenders might quote their interest rate in an annual percentage rate, an APR, while others prefer to use daily or monthly rates. Oh, and don't forget about those sneaky fees and varying repayment terms. Try calculating the equivalent APR for each loan. That way you'll have a clear picture of the annual interest rate for each option. In Moby's Microfinance for Entrepreneurs session, you can check out the How to Choose a Microfinance Loan section, where you'll find a sample comparison chart that calculates the cost of different loans. Up next, we will talk about a partial list of lender types to consider. Microfinance. Microfinance is the delivery of financial services in small amounts, mainly loans, to entrepreneurs who typically do not have access to traditional financial services like banks. Organizations like Kiva, Opportunity Fund, and Grameen Foundation are all options. Microfinance's interest rates are usually considerably higher than those of mainstream banks since the risk to the lender is much higher. Microfinance is available around the world, and while the interest rates are typically higher than banks, about 40% on average globally, they're lower than informal money lenders or loan sharks, whose interest rates can be 70% or more. Also, in some countries like China and Vietnam, governments have enforced interest rate caps on microloans. So let's talk about crowdfunding. It's an exciting way to raise funds for your project or business, usually over the internet, in order to reach as many contributors as possible. But there are a few things you need to keep in mind before diving in. First off, there are different types of crowdfunding platforms out there, like Kickstarter and GoFundMe, each with their own unique features. Before you get started, it's essential to do your research and find the platform that best suits your needs and goals. Crowdfunding income is usually considered taxable income. Unlike a traditional loan where you're expected to pay the money back, crowdfunding is more like a donation or a contribution from your supporters. So from a tax perspective, that money is seen as income. It's important to keep that in mind and be prepared for any tax obligations that may come with your crowdfunding campaign. Some crowdfunding platforms work on an all-or-nothing basis. If you set a funding goal and you don't reach it, the people who contributed to your campaign will get their money back. It's a way to ensure that you have the necessary funds to carry out your project or business. So make sure you understand the rules of the platform you choose and set realistic funding goals. Some crowdfunding campaigns may unintentionally end up selling ownership shares of the company. That's something you want to avoid unless you specifically intend to offer equity in your business. So double check the terms and conditions of the platform to ensure that you're not giving away more than you bargained for. Peer-to-peer funding. Ever heard of peer-to-peer lending? It's a way to connect borrowers directly with individual lenders through online platforms like Prosper or Lending Club. Just make sure that the platform is licensed and certified by the state. It's a great alternative to traditional banking. Equity financing. Equity financing uses an investor instead of a lender. If you were to close the business or end up in bankruptcy, you would not owe anything to the investor who, as a part owner of the business, simply loses their investment. It is important to realize that investors own a part of your business and may expect to be involved in decision making. Equity financing is fairly rare for very small businesses, including solopreneurs, and more appropriate for larger companies. Angel investors. Angel investors are individuals or groups who invest their own money in someone else's business. They're not really into building an entire business from scratch, but they love getting involved in specific products or projects. The cool thing about angel investors is that they usually don't expect you to make monthly payments to them. Instead, they get their investment back when your company goes public or gets sold. Just keep in mind that their ultimate goal is to eventually sell the company, whether that aligns with your goal or not. Venture capitalists. Venture capitalists are professional investors who use funds raised from limited partners to invest in new ventures. Venture capital firms typically deal with massive investments, often in the millions of dollars range. So brace yourself, because the process can be quite slow, and the terms of the deal can get pretty intricate. Specialized lenders. There are other specialized lenders out there who are all about supporting small businesses and helping them grow. If you want to find these resources in your area, you can reach out to your local city offices or chambers of commerce or do an online search. Community Development Financial Institutions, or CDFIs. CDFIs are U.S. Treasury certified organizations, often nonprofit, that support economic development in their communities. These organizations often provide funding for businesses that are not able to meet the minimum requirements of traditional banks. These organizations often provide educational services, advising, and other programs that can support small business development as well. An example of a CDFI is the Community Economic Development Fund, or CEDF, a Moby partner serving Connecticut. You can learn more about CDFIs at cdfifund.gov, and you can search online for the list of CDFIs in your community. Economic development organizations. Like CDFIs, economic development organizations are often nonprofit and are focused on promoting small business development within their communities. Many are state or local government entities. They can be a great resource of information, education, and funding opportunities for new businesses. What kind of money to get? Loans. A loan is a debt, an amount of money borrowed that gets repaid with interest over a fixed amount of time. The person receiving the loan is often personally responsible for its full repayment, even if their business or venture doesn't go as planned. Secured loans. A secured loan is a loan that is guaranteed or secured by collateral, something of value, that could be repossessed or sold in the event that you cannot pay. For many small business loans, this collateral is the business itself, the income and assets. Other examples of secured loans where the lender would repossess or take ownership or sell the collateral include pawn shops, home mortgage, car loans or leases, Small Business Administration SBA-backed loans, equipment leases or loans. For example, car or equipment loans or leases that you're paying off, which could get repossessed if you fail to pay. Most small business loans are secured by your business income and assets, personal income and assets, or both. Collateral. In simple terms, when you borrow money from a lender, they might ask you to provide something valuable as a guarantee, called collateral. This collateral acts as a safety net for the lender. Common examples of collateral include your home equity, the portion of your home that you own, any money owed to your business, the inventory your business has, or the equipment you use. The whole point of collateral is that if you're unable to pay back the loan, the lender can take possession of and sell the collateral to get their money back. So it's important to be cautious when dealing with loans that use unrelated collateral. Let's say you're taking out a car loan. In this case, the car itself acts as collateral. If you can't make your car payments, the lender has the right to repossess the car. However, once they do that, you're no longer responsible for the loan. This is an example of a secured loan done right. On the other hand, it's risky to use the same car as collateral for another loan if you haven't fully paid off the first loan. In that situation, if you can't pay or you default on the second loan, You could end up losing the car and still owe the money on the first loan, the car loan itself. So, when it comes to collateral, it's crucial to understand the terms and make wise decisions to protect yourself and your assets. Unsecured loans. Unsecured means that there is no collateral securing the loan. However, they may still be personally guaranteed. Examples of unsecured loans include credit cards, some lines of credit, friends or relatives. Line of credit. A line of credit is like having some money on standby in case you need it. You only have to pay interest on the money that you actually borrow, even if you have access to a larger sum. However, there is usually a yearly fee, and the bank may require you to renew the line of credit each year. This means that you might have to show that you're still trustworthy with your credit, or else you could lose access to the funds. Term loan. A term loan is when you borrow a specific amount of money and pay it back in monthly installments over a set number of years. You receive the entire loan amount up front and have to pay interest on the entire sum, regardless of whether you use it all or not. Repayment plans. When you're looking to borrow money, it's important to tell lenders how you intend to use the funds and when you'll be able to pay back the loan. This information is usually presented in a well-prepared business plan. When you create your loan packet, consider including a repayment plan. While there are usually different lengths of repayments available, it shows potential lenders that you've put real thought into what you need to borrow and a game plan for how long you think that it will take to repay it. It shows that you're not just focused on getting the money, but also on managing your financial obligations responsibly. If you want more guidance on choosing the right loan, you can check out the How to Choose a Microfinance Loan resource in the Microfinance for Entrepreneurs session. It provides a handy chart that compares loans with different repayment schedules and shows how those schedules can affect the total cost of the loan. Investments. Investments are purchases of an asset by angel investors, venture capitalists, etc., as mentioned previously, like a business or stocks that will produce income over time. Investments are risky for the investor because if the business fails, the investor will not be repaid. Investors often seek some ownership in the company, also known as equity. But hey, if you're not quite ready to share ownership decisions, it's wise to be cautious about bringing in investors too soon. Take your time and find the right balance. So what about stocks? Larger businesses that have plans to go public in the future may consider stocks to generate funding. However, it's not very common for small businesses and solopreneurs, so we won't dive into that in this course. Your lawyer and accountant would be your guides if you decide to go that route. The beauty of equity investments is that you don't have to pay it back on a monthly schedule. You need to be honest with yourself about how you feel about having someone else in your company. They'll be a part owner, and that means sharing profits, decision-making, and answering to them indefinitely. Grants. Unlike a loan, which you have to repay, or an investment where you are giving up some ownership in your company, grants may be available to your business through a variety of sources. Some can be used for any business expense, and others may have limitations regarding what they can be used for, such as rent, payroll, etc. To receive a grant, you'll typically need to go through an application process. You'll need to show that you meet the grant criteria, and sometimes you may even have to later prove that you've used the money as specified by the grantor. But here's the best part. If you meet all the requirements, you don't have to repay the grant money. A similar concept is a forgivable loan. Grants are often targeted towards specific types of small businesses, such as those owned by veterans, women, or minorities. But you can check with your local Chamber of Commerce, small business nonprofits, the federal grants.gov website, or do an online search to see some of the grants available and whether you might qualify to apply. Some cities even have special grant programs funded by the cities themselves. For example, if you're planning to open a retail store, your city might have grant funds available for site improvement. Sometimes private companies also offer small business grants as part of their community involvement or philanthropy programs. Evaluating lenders. When it comes to picking a lender, you should evaluate them as carefully as they evaluate you. Consider how much money you need and whether the repayment terms fit within your plan. Make sure you understand and can comply with all the terms of the loan. Terms include the length of time you have to repay, whether or not you have a fixed or variable interest rate, if there is a repayment penalty, and if collateral is needed. When comparing lenders, look at how much money each one is offering and the cost of the loan. The interest rate is a percentage of your principal loan balance and is included in your monthly payment amount. As mentioned earlier, the annual percentage rate, or APR, is the best way to calculate the cost of your loan. plus any additional fees charged by your lender. Look for lenders with good ratings from previous customers to get a sense of how a lender operates and supports its customers. You might also want to consider giving preference to lenders who have experience in your industry. They tend to be more understanding of unique situations and are often open to exploring creative solutions. How to get the money. The 5 C's of lending. Let's look at the 5 C's that lenders use to evaluate potential borrowers. Capacity. Capacity is the ability of a business to repay the loan. Your business plan should show that you are planning to generate enough money from normal operations to easily cover loan repayments. Capital. Capital is the amount of money and/or equity the borrower already has and the ability to fund the business if things don't go according to plan. Collateral. Collateral is the resources outside of the business, ideally liquid assets like cash, that can be repossessed or sold to get the loan repaid in the event that the business defaults or fails. Conditions. Conditions are the timing and economic conditions that impact the potential business and whether or not it's a good idea right now. Character. Character refers to the variety of other factors that make a potential borrower an attractive or unattractive risk, like personal credit score, industry, or other relevant work experience. Each lender has their own lens, their own preferences. Don't be disheartened by a rejection. Start by familiarizing yourself with the common requirements lenders often look for. Reach out directly to your preferred lender and ask them which of the C's they place the most value on. It's a good idea to have your basic information ready, like your business plan. Lenders want to see your vision and how you plan to make those profits. Also have your basic financial reports and tax returns at the ready for review. But hey, don't venture into this alone. Seek guidance from an advisor, like your personal banker or accountant. They can offer help to ensure your materials are clear, complete, and ready to impress. For a business loan, the most common documents needed are business financial statements, business and personal tax returns, business plan with budget or projection. A good advisor can also help you prepare a letter of explanation that highlights your character, your fiscal responsibility and financial performance, and how that applies to your new business venture. For example, if you have excellent credit, you could highlight your ability to use debt responsibly and pay it back on time. Or you may be able to talk about business successes from your research and development phase, referencing happy clients or successful stories, pre-orders or reorder rates, the size of your mailing list, and other non-financial factors for success. You could also mention your entrepreneurship education and include your MOBI certificate of completion for your course. Be ready to answer questions about your business and be able to back your plans up with research you've conducted about your business and the market, evidence of past successes in other areas, or proof of concept information that you've gathered. After you get the money. All right, let's talk about what happens after you get that money in hand. It's not just about celebrating the victory. There are a few things you need to keep in mind to stay on top of your loan. First things first, make sure you fully understand the requirements of your loan. Take the time to read through the fine print and grasp what's expected of you. Aim to meet or even exceed those expectations. Picture this. You have the chance to pay off your loan early. Exciting, right? But hold on. Some loans come with an early payment penalty. So, be smart and calculate the overall cost of paying early versus sticking to the full term of the loan. Find the right balance between freedom and cost effectiveness. Oh, and here's an important note. Some lenders may request regular financial statements, so make sure you produce them on time and regularly. Remember, credit worthiness is more than just paying timely payments. It's a journey you continue to build throughout your life. So keep working on that credit rating. Communication is key in any relationship, even with lenders. Stay in touch with regular updates, even if it feels like there's nothing new to report. It shows your dedication and keeps the relationship strong. If ever a problem arises, don't panic. Be proactive and communicate with your lenders. You never know, they might be willing to offer a temporary pause on repayments. Quick tips. Remembering these quick tips can help you navigate the lending process with more confidence and increase your chances of success. Find a lender that fits your needs. The best access to a lender is through a referral from a business contact, your banker, your tax preparer, your lawyer, or a friend. Don't expect anyone to loan you money just because you want a loan. You have to show the lender that you are highly likely to succeed. Take the time to be prepared and confident with your presentation. If you feel rushed or desperate, you aren't going to present yourself as a good risk. If you haven't filed taxes in a few years, get those up to date. Improve your credit score as much as you can before applying for credit. Be prepared to discuss and explain any negative marks on your credit report. Have a well thought out, realistic, and researched business plan. Be upfront with your lenders. Highlight the good, but don't try to hide the bad. Lenders are looking for a realistic plan, not the best case scenario. Keep your lenders informed of any changes to your business or your business plan, even after you get the loan. If you see that you're unable to make a scheduled loan payment, be proactive and call your lender in advance to explain the situation and talk openly about options. Control your costs. Only spend money on things that will bring in new income in the next 90 days. Delay any costs that are not directly related to producing income. Avoid putting everything on credit cards. Only charge what you can afford and negotiate for a lower interest rate when possible. Aim to pay the full balance each month, not just the minimum payment. The top 10 do's and don'ts. The top 10 do's. 1. Live frugally and understand how your personal finances impact your business and vice versa. 2. Before looking for a loan, know how much you need, how you will use the money, and how long you will take to repay the loan. 3. Regularly review your credit report for accuracy and improvement. 4. Start to save up money to start your business. 5. Remember that investors own a part of your business and may expect to be involved in the decision making. 6. Determine how much money you will need until you're able to make a profit. 7. Create a list of potential lenders or investors to choose the best fit. 8. Ask for help. Ask for referrals to lenders to find the best loan terms. 9. Create and keep current a financial information packet, including cash flow projections, financial statements, and recent tax returns. 10. Leave room for the unexpected in life. If you think you need a loan for 6 months, ask for 12 months to be safe. The top 10 don'ts. 1. Don't expect a bank to help finance your new business just because you want a loan. 2. Don't ask for a loan without a strong business plan, including a realistic repayment plan. 3. Don't exaggerate or overestimate your expected income. Make sure you have a product or service that people are willing to buy now before asking for loans or investments. 4. Don't ask for the bare minimum. Make sure to get enough to cover unforeseen expenses. 5. Don't overlook the invisible cost of cash flow when estimating your earnings and expenses. There is a gap between the money you spend to produce what you sell and the money from the eventual sale. 6. Don't forget to include pay for yourself as the owner in your financial calculations. 7. Don't risk your financial future or personal relationships by taking out a loan that you can't repay. 8. Don't overspend on nice-to-have startup costs. Be brutally frugal. 9. Don't overlook creative or unusual sources of financing. And 10. Don't give away equity or ownership in your company without understanding the consequences. Congratulations on completing this session. If you're writing your business plan while taking this course, take a moment now to include any information about your business related to this session. Moby's free business plan template and other worksheets, checklists, and templates are available for you to download. Check out the list of Moby resource documents on the resources and tools page of our website.
This session can be taken on its own or as a part of a full course to earn a certificate of completion and/or digital badge from Moby and Santa Clara University. If you're taking this as a part of a course or want to enroll, be sure to log on and take the corresponding quiz or final exam as appropriate. You can access more topics, courses, and helpful information for your business at www.scu.edu/MOBI.